Behind me is the vacation of your dreams, hundreds of new experiences, and the time of your life. But if you're like most Americans, you're overworked and underpaid. That means paying for one of these dream vacations is gonna take something different. And I've found it. I'm gonna show you 5 of the most popular getaways and 5 stocks you can use to pay for the vacation you deserve. Don't think it's possible? Don't think you can pay for a vacation from just a few hundred invested in stocks? Investing just $100 in shares of Netflix 10 years ago would now be worth over $2,039. More than enough for that Vegas vacation you won't remember. Investing $100 in Amazon 10 years ago would have grown to over $2,200, taking you to the sun and sand of Bora Bora. But who wants to wait 10 years for that vacation you always dreamed of? I have found 5 stocks that can get you there in half the time. I'm going to show you those 5 stocks and 5 dream destinations, along with what to look for in a stock that will pay for your vacation. First though, I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. We're starting with the ultimate dream vacation in Bora Bora. You'll sip rum from coconuts as you relax on the beach or create memories with your family. Okay, you'll probably just sip a lot of rum and then just relax. All that fun and sun doesn't come free though, and it's going to cost you about $1,564 for resort fees and a flight from New York. So you're going to need to pay for that somehow. And our first stock to pay for your dream vacation is PubMatic, ticker PUBM. PubMatic is the leader in programmatic advertising. That's automated ad buying through a platform like bidding on a commercial space instead of the traditional route of working through an agency. The company controls about 4% of a market that is growing fast, especially in streaming. This isn't just internet ads we're talking about here. The ads you see on TV, cable, and in apps, they're all moving to this process. In fact, PubMatic reported sales growth over 150% in the last year in that cable TV segment. The company estimates it can grow market share by over 5 times to 20% over the long term, which would be a huge control of this market. More than just the revenue growth from that though. In this industry, higher market share means more data, and that is pure gold in advertising because it's going to allow those advertisers to be more efficient with their ad targeting. So as PubMatic gains and then controls that market and grows, more and more advertisers are going to want to use its platform. That has helped the company buck that downward trend in weak advertising revenue. Even as other platforms like Facebook are reporting huge decreases in ad revenue, PubMatic has been able to report 40% plus spending growth across its top 10 categories. Now I know a lot of investors are going to be looking at this stock, or really any stock on the list, see it's down 74% from its peak over the last year and think I've lost my mind. But these are still growth companies, all of them in growth industries that are changing the world in which we live. And where I was warning investors in 2021 that they were just wildly too expensive, now, all these stocks on this list are at a huge discount to their fair value. Nation, this is exactly the same thing we saw in 2002 after that bursting of the dot-com bubble. Shares of Amazon plunged 95% from its 1999 peak, but for investors that were able to see that longer view, a company changing the world, the stock has multiplied their money by 161 times the investment. And this is going to be exactly the same thing with the companies I'm showing you today. They may not all be the next Amazon, but they are all dominating their growth industries and will multiply your money. Revenue for PubMatic is expected to reach $285 million this year, and I think that's underestimating the potential. The company grew sales by 31% over the 3 years from 2018, and I'm estimating $420 million in sales through 2025. If we use just a 4 times price to sales valuation, that gives us a $1.68 billion company and a $32 stock price for a 113% return over the next 3 years. If sun and sand aren't your thing, you're going to love our next hotspot. But stick around after all 5 because I'm going to show you exactly how this is going to work, how investing in just a few $100s a year can pay for your vacation every single year. Next stop, fabulous Las Vegas. Last time we were here, my wife was mega pregnant with our son, so didn't have nearly as much fun as I did. I had a great time. All she had was morning sickness. In Vegas, you'll stay at the fabulous Motel 6 off the I-15 exit ramp. Wait, that's not right. You're going to stay at the slightly more luxurious Mandalay Bay Resort for $946, including flight. If you're going to Vegas, maybe you want to brush up on your gambling skills with shares of DraftKings, ticker DKNG. Like PubMatic and really all these stocks, DraftKings has been hammered over the last year, down more than 70%, but it has one key criteria for investment that I'm going to show you later. One key that means that this is the investment you want to make now while everyone else is selling. 30 states and DC now allow legal sports betting, with 10 just in the last year, but it's still just a third of the total population, so this is a market with a lot of growth left. DraftKings is in 17 of those states, expanding aggressively, especially into New York, which is a new market for it, but still has growth in California, Texas, and Florida to look forward to. The American Gaming Association estimates that 31 million Americans placed bets during Super Bowl last year, an increase of 35% from the previous, and $7.6 billion in wagers was double that previous year. That means not only are more people betting, but they're betting more, and it means more in sales for companies like DraftKings. DraftKings reported 1.6 million average monthly players in its most recent quarter, an increase of 23% from the last year, and an average revenue per player that doubled from $47 to $100 each. Sales are expected to reach $3 billion this year and grow to $4.3 billion by 2025. Now, on the current market value, the shares are trading for 3.2 times sales. That's down from more than double that, down from 10 times during the pandemic. At a valuation of just 4 times sales on that 2025 revenue estimate, the company could be worth $17.2 billion, or $39 per share, and a 140% return in 3 years. Now, you'll have to buy the stocks in this list, but you can also get free stocks by signing up for the Webull Investing app. Use the link I'll leave in the description below and get 3 free stocks up to $3,300 when you fund a new account. Free is always great, but what I really like about the app is the stock simulator that allows me to test out ideas and track stocks before investing my own money. So check that out. Our next relaxing rendezvous. Well, this time see if you can guess the destination. Fine wine, pasta, and gondola rides. The closest we've ever been to Venice, Italy is the casino in Vegas. I'm pretty sure the real Palazzo wouldn't advertise a David Spade concert. Going to the real Venice, though, means going in style, and that means the 5-star Duttori for $1,384, where you'll enjoy romantic dinners after a gondola ride through the city. Datadog Inc., ticker DDOG, is one of my favorite tech stocks and one of the larger companies on the list. The company is an IT service provider monitoring all the data generated from a business and then analyzing that for security, management, and efficiency. From a unified platform focus in 2010 to a multi-product cloud monitoring system today, this is the kind of innovation that we're going to talk about when I detail what I'm looking for in a great tech stock. The company has historically spent upwards of 40% of its sales on research and development and other capital investments, helping them to drive that constant innovation. And being able to cross-sell its 20,000 customers into different products makes them extremely sticky. More than 4 in 5 customers use at least 2 products, and a third use 4 or more on the platform. It's helped sales grow at a 74% annual pace over the last 5 years, while the company also gets more profitable, improving the operating margin to 0.34% from negative 5% in 2019 because it just costs less to keep a customer than finding new ones. Revenue is expected higher by 33% this year to $2.2 billion, which means the shares are still trading a little expensive at 15 times on that price to sales ratio, by far the most expensive on the list that I'm going to share, but I still like this upside. Those sales are expected to continue to grow by about 40% a year to $4.3 billion by 2025 and take earnings higher with it. Even on that same price to sales valuation, that would mean a share value of $180 each, or 120% return in those 3 years. Next, we're visiting the daughter of the desert, Marrakesh, Morocco, where you'll haggle with shop owners for exotic spices and rugs and marvel at the beauty of the Palacio de Bahia. This oasis is surprisingly affordable at just over $1,000 for flight and stay at the Fella Hotel. And to pay for it, shares of Teledoc Health, ticker TDOC, fell with the market, but the company also continues to dominate one of its most exciting trends. Teledoc is the global leader in virtual healthcare with a provider network that covers 76 million US patients and 1 billion member data points from traditional telehealth to remote monitoring and next-generation primary care. Obviously, those pandemic years were huge, like 5 years of growth all in one, but the company was already growing at a solid rate before that. Membership growth grew from 20% annually since 2018, and the company booked nearly 18 million patient visits last year. Revenue increased 17% in the year to the third quarter, and much of that was from recurring services, so I like this for that stability, even if that growth in telehealth slows from that pandemic faster pace. Longer-term telehealth and virtual care is the future. Shares now trade for just 2 times on that price-to-sales basis, down from a ratio of 17 times during the pandemic on a stock still growing by strong double digits. Even on a very conservative price multiple of 4 times its 2025 analyst sales target of $3.5 billion, That is a $14 billion company for a 191% return to $80 a share. I'll reveal that last dream vacation and the stock to pay for it next, but I can't just drop a list of stocks in your lap and say, hey, go buy these. I want you to be a better investor. So here, I want to show you what I'm looking for in these vacation stocks. And first has got to be massive growth. Planning that dream vacation in a few years is the perfect timing to let some of these growth stocks that have plunged over the last few years to rebound. We love us some dividend stocks here on the channel, but you'll never beat the kind of fast growth returns you get from these growth stocks. That means looking for the companies that are able to grow their sales, their revenue by at least 20 to 25% a year and able to continue doing that. For that, you can use a stock screener or go to the income statement on Yahoo Finance. Under the Financials tab here, we see the company's revenue over time. Companies able to grow their sales that fast could be cash machines in the future, and that's going to mean returns when the stock market bounces back. Now, we're not buying just any growth stock, though. We want to find the leaders in growth industries. First, by looking at those fast-growing industries, every company in the group is going to do well. We're talking industries like virtual healthcare, fintech, and online gambling. The market for these industries is just growing so fast that a company has to work hard not to make money. But then by looking for those best-of-breed leaders in those industries, you're getting a stock that is going to amplify that growth for even stronger returns. Here, I'm talking about companies with some kind of a competitive advantage over its peers, like a unique product or a distribution model. And here, understand, while we're having fun matching one stock with each destination, I'm also looking to make a portfolio of at least 3 to 5 stocks here. By putting your vacation money in several growth stocks, you're getting on that plane, even if one of these stocks flops. I have saved the best vacation and my favorite stock to pay for it for last, but stick around because next, I'm going to show you exactly how much to invest to get you on that plane. The Carnival in Rio is mid-February, which makes it the perfect time to go from this to something more like this. While you're there, you'll stay at the famous Copacabana Rio and enjoy breathtaking views for $1,400 round trip. Now, I recently highlighted Sofi Technologies, ticker SOFI, as my favorite long-term growth stock, and it's already up 40% since that video. Sofi started as an online student loan refinancing platform, but has evolved into a full-service fintech wallet. I believe one of the best positions for the future of digital banking. Where other fintech platforms like PayPal and Upstart are still trying to bring on their products and services, Sofi already has the lead in everything finance, from insurance to credit, investing, and banking. Here, a big part of why I've been buying the shares over the last year is the company's competitive advantage in that digital banking space. Because it has that banking charter from its acquisition of Golden Pacific Bancorp, it's able to offer all the services from checking and savings that many of its fintech competitors just can't provide. This really does put Sofi way ahead of the competition, and the company is growing using that leverage for growth. We saw that strength in the company's most recent quarter, with revenue up 51% over the last year to $1.3 billion, and net interest income up 101% as Sofi really flexes its banking muscles. Expectations are for 28% growth to $3.2 billion in sales over the next 3 years. And all this is happening as management expects to improve on profitability from just 3% EBITDA margin to 11% this year. Shares are priced right now at 2.7 times on the price to sales basis, and we'll stick with our 4 times multiple, but just on those expected sales, it could be a $13 billion company in just 3 years. That is a 140% return to $16 per share. Wow, 5 dream vacations and 5 stocks to pay for it. But I know a lot of you are still saying, yeah, but I still have to wait 5 years to travel. I'm ready to go now. With this strategy I'm about to show you, you can go on a dream vacation every single year. Throughout the video, I've estimated how much to invest in each stock to pay for your vacation. Well, that's a one-time investment, and spread throughout the year, it's less than $50 a month. So instead of thinking about this as a singular investment for that one dream vacation, but think of it like a travel fund. Every month you invest $50, you're going to build up to $600 by the first year, and after 5 years, that money will have grown to pay for your vacation. But then, if you're investing every month, you're going to be able to pay for a new vacation every single year. When you finally get back home, it's back to paying the bills. Click on the video to the right for the dividend stock I use to pay my rent. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.